G'day, Peter.
Hey, Woody, how are you?
Good. I'm very well. I've come into the office today, so it's a nice change.
That's fantastic. I'm in the office as well. It's beautiful. I'm just in a different room than you, but we can pretend to almost talk together, right?
Yeah. We were just chatting before we press record, and it's been about 4 years since we first met, but it almost feels like that time since we last had a chat
Yeah,
for
it's a
the
while
readers of
ago.
Insider.
Yeah.
For those that don't know, do you want to just give a very brief update? Because we've had lots of new readers in the last 6 months or so. And not many people may know who you are. I describe you as this enigmatic mad Dutch algorithm builder. Do you want to explain, just to reacquaint readers with what you do?
Yeah, absolutely. So basically, I'm Dutch, and once you move to an English-speaking country past 30, you never lose that accent. So I gave up on that one. But yeah, for the past, let's say 12 years, I've been running my own money through algorithms. And um, at first, simple, and then more and more complex, but also because the world is changing so fast when it comes to machine learning and AI, I got more and more into it. And then, yeah, about 4 years ago, we were sitting in a pub, and I pretended to be a nanny, I think. Yeah. I said to you, asked me, what do you do? I said, well, look after the kids.
Yeah.
Uh,
Yeah.
but what I actually did is I traded my own money with algorithms. And my vision about algorithms is that algorithms should be the way we trade, right? Should be accessible to you, people like you and me. And that means that we have to write algorithms that hedge funds usually don't want to write. Yeah. So we assume that algorithms of the market goes up in the long term. And it's a matter of allocations of assets rather than making all these outrageous, high frequency, every second buy and sell things, right? So what we're doing is I think most subscribers know, we switch between two asset classes, bonds and equity and cash. And I think when I have to explain to my grandma what we're doing, so well, when the market goes down, we try to be defensive so that we win more. We are winning by losing less.
Mm.
And by doing that, and by jumping back into the market on time, we basically write it up. And then when it becomes too much,
Yeah.
too volatile, we jump out.
Well, that's the key thing about it, right? But going back to when we met, like you said, you were just a babysitter, what you did in the day, but I could tell there was something deeper beneath the surface. You're actually trading the options markets, I think, while everyone else slept. I always wondered why you always woke up later than everyone else, but that's what you were doing. But you were using algorithms in order to do it, and then you told me about this algorithm that you were developing, which, as you just said, it's like you literally switch between two different asset classes, and that's really all you need to do. It's a really simple idea.
Yeah, it's simple, and I showed you then, right, the back tests from 2007 to 2018. When 2018 I started to trade it myself on my super accounts. Then before that, it never had a losing year, and it still has never had a losing year, right? So, and this year we're still good up. Although this year has been a strange year, isn't it? With the aftermath of COVID and all the volatility that ensued out of China. But yeah, all these events happen all the time, right? This last year was COVID, this year it's China, 10 years ago it was a war, it doesn't really matter. Events happen, and the algorithm is able to find the stress that the market makers feel. Because market makers, they have to defend their positions. They have to defend their positions in the option market. And in the option market, you cannot hide. It's an open market. And because you cannot hide, we can see the premium they are willing to pay. So we basically see what they're actually doing with their money rather than what they say what they do. And, it's always more important to ask people what they do with the money instead of what do you think they do with their money.
Yeah. Well, yeah, it's a really interesting thing. So just so that everyone understands it measures two key metrics. One of them is the economy with the relationship between gold and copper.
Yeah.
And, I'm just going to be describing it very basically, but the basic thing is if copper's strong against gold, it means the industry's firing and it's a more bullish economic outlook. If gold's more weight against copper, it means that people are a bit more fearful and there might be a bit more of economic headwinds happening at the minute. And then on the other side, you've got, as you say, the price of risk in the market. What are market makers paying in premiums to protect their positions? And that gives you some vital information, doesn't it?
Yeah, and it's important to understand, and that's sometimes I have these discussions with our subscribers, is that this copper gold ratio, copper represents industrial activity and gold more protective behavior, right? And what we do is not look at the spot price, but about a relative movement. And if you want to measure the relative movement of an algorithm, it becomes a very slow thing, right? So this is a slow movement, which, by the way, has a high correlation with how the bond market behaves, so the 10-year yields in the US. And then we needed a faster metric, and that's the risk metric. So at the moment, we are 60-40, right? We're 60% equities, 40% bonds, which I think at the moment is a good indication of where the economy is. It's not too hot, not too hot, not too cold. That's a bit of a Goldilocks.
Yeah, but we've been in bonds for a long time. It was only last week it switched.
Yes. And I think this is really important, Woody, because we only have seen an environment like this where we have a lot of stimulus, we come out of recession, and therefore we have a lot of slack and tension in the labor market. The slack in certain areas and the tension in other areas. And we have inflation. And the problem with inflation is this, that inflation and bonds are no good friends. They live on opposite sides of the track. And what we need to do now, that if you use bonds to protect yourself, or the 40% we have now allocated to bonds, just take inflation protected bonds, because the inflation is not transitionary. That's my belief.
So let's just talk about that, because can you explain what people mean when they say inflation is transitory? Now, that's a big thing that Biden's coming out. Don't worry, this is only short-lived. Can you explain what it is and why you think that that's BS?
Yeah,
to be blunt.
Well, it actually it's relatively simple, and it's what economists call the elasticity of pricing. Yeah. So if you buy fuel for your car or toilet paper, you're not that sensitive to the price, right? Your car is empty, you have to fill it up, whether it's 180, 140, or $1. But there's a lot of movement up and down in prices, and that's determined by the fuel market. For toilet paper, you buy a big bag of toilet paper or diapers or whatever, and the prices are relatively stable. And when they increase, they increase. When they go down, they go down. That means the price is very elastic. Now, The problem is that if prices rise in the economy, with a lag, wages start to rise. And the problem is wages are not elastic, they're inelastic. That means that in the end, wages, when they go up, they seldom go down. When wages go up, then the inflation is sticky. So wages go up, the prices for companies will increase, the total cost base will increase, and therefore they have to keep the prices high. So the main difference is, if people say it's transitory or not, is the argument is not whether inflation itself is transitory. Do we see inflation in wages? Now you have to talk. I mean, you are CEO of a business. I speak to small businesses every day, and everybody says that wages are going up, and especially in the lower end of society, right? So the service jobs. The moment they go up, they don't go down anymore. So then inflation becomes sticky. Now that's a big discussion. And I think we see too many proofs that because of the high tension in the labor market and skilled jobs, plus higher prices. I mean, the official inflation was around 6% in the US. But if you look at the things that they don't count, that the inflation is already above 10%. It doesn't have to be that long above 10% because of compound interest. If you have an inflation of 10% during 7 years, all prices have doubled. You know? So it's really important that the US start to somehow control this inflation. Now, yeah, the problem is you cannot control it if you're still pumping a lot of money into this society. You still have, you buy still bonds, you buy still mortgages, and you keep the interest at 0.25, right? What
are your thoughts on where it's going to go from here? I know you don't, in the way you trade, you're an algorithmic trader, so you don't
have an opinion.
But you must think about these things, right?
Yeah, no.
What can the Fed actually do? I mean, in your opinion, is it a catch? It's a bit of a catch-22, right? So if they do decide to do what, I mean, Nick Hubble and I were talking about this last week. We were talking about what the Fed did with Paul Volcker at the end of the 70s. He really tightened the screws, which caused you have to have a strong leader or a strong person in that to withstand all the. I mean, they were burning effigies of him. But how would?
I mean, Powell is in the end of his term, so and he is really a dove, right? So he doesn't want to raise. And if you look at the whole constitution of the Fed board, there's only one person that consistently says raise. I think it's Clarida, but the rest not. And that's one element. So there's a very dovish board now. So, but there's a few people leaving soon, and there were 2 people fired, right, because of trading, insider trading, shenanigans. And so they have to put more people on the board. But Biden himself is dovish, and there is the secretary of Janet Yellen, who was a minister for Biden. She used to head up the board. She's also a dove, right? So I don't expect there will be what they call a hawk in there soon. But so what I expect is what will happened in the 70s as well, but hopefully they learn it a bit quicker. Is that they keep on saying it's transitory until they say it's not. And then they have to really pump the brakes. And what they will do, they have to stop the economy from overheating and to stop inflation. they have to raise the bond prices. Now they can do that in several ways. The most classic ways is just to get the fund rate up and then let the curve do the rest of the work. So the whole curve goes up. If the yield goes up, we all know the yield goes up, the bond prices go down.
Mm-hmm.
And so it's not so good to be in bonds then, straight bonds. But you have this other class of bonds that's called inflation protected bonds, TIPS and IBL here in Australia. They are protected to inflation. And then you have also some ETFs, like one is called INFL, which actually uses inflation as a positive contributor to the fund. Mm. But yeah, it's what I expect is that it runs out of control. They have to step on the brakes, and they do that too late, and they cause mayhem.
Before that happens, is there going to be a kind of like a blow off top?
Blow off top. It's a blow off top in some asset classes that are very sensitive usually to interest rates and are very sensitive to inflation. So commodities, for example, they tend to just go up. And I mean, in my personal portfolio, I bought some options on the general DBC ticker. That's basically a general commodity ETF. And yeah, it's doing really well because what happens, we all see the fuel prices at the station, right? At the fuel station, we see it in daily things we buy. Things are getting expensive. There's a lot of inflation at the moment. And we, as a country, have a very interesting position because we export commodities. So we can command more and more money for our commodities. That's great. But we also import a lot of stuff. So we import other stuff and we import a lot of inflation. And so that will bring dislocations in the industries, right? Because some industries get a lot more money and they pay it out of dividends or they do other things with it. And then some industries, they get squeezed because their import prices will be much higher and they might not be able to command the premium here in Australia. So their profit margins get squeezed. And especially with companies that have to order far in advance. So like in the Wesfarmers Group, you have Kmart, Target, Coles and Lesser, but they have to order the new fashion lines. They have to order half a year in advance, right? So they have to pay very high prices now, but we don't know what the prices will be in 6 months' time or in a year time when they actually can sell it, right? So their uncertainty increases, and that's, you know, we will all feel it. We will all feel it.
What are you meant to do in the meantime? With the bulk of you, say if you got the bulk of your capital, you don't want to put it at unnecessary risk, but it sounds like, I mean, just from the algorithm being in bonds, like it's a risky, it's been a risky time to be in the market, yet you see the nominal gains and it looks like, oh, the markets are going up. Yeah. We had this discussion. It's like the algorithm this year is gone exactly as expected. I was actually really impressed by it. My account's grown. Has it beaten the market? No, but you've got to look at it from an inflation adjusted, a risk adjusted perspective.
Risk adjusted, yeah. If you see the graph, so every few weeks I put the graph in of the accounts, and you see that it's not in the levered version. The levered version is a little bit gambling, right? But in the other version, there's a steady uptrend and it's not as volatile as the market. And that makes you just sleep better, right? Especially if it's a serious amount of capital. And I spoke to quite a few subscribers who say, yeah, I can't buy these inflation protected bonds because, you know, my broker doesn't have it or my super company doesn't allow it. And for them, I would say, well, don't put all that money in bonds then. Maybe only a part, or maybe none of it, and keep it in cash. Right? Because if you buy bonds now, full on, you have a chance to be taken to the cleaners when the U.S. market starts to raise rates. And it's not only raising rates explicitly, it's market looks ahead, right? The market starts already to price in the next rate increase. And now the pricing in is not so much. I mean, we're now at 10-year rate at 1.56. It's a big change from the 0.5 where we were, but it can go to 4, 5%, 7%. And then those bonds will tank really, really hard. Because there's one thing I want to say about this. There's one piece I wrote like a few months ago about convexity. You know, the bonds, they don't price linearly; they price as a smile. So the closer you get to interest rate zero, the faster they move, the more aggressive they move. And that's really important to realize, that bonds are usually a very good protective instrument as long as they are in the normal ranges. But the moment they start to be on the edge, they become very predictable but volatile instruments.
You said to me we were having a chat at our local gym where we still go all these years later, and it's nice to be back there actually working outside. Hopefully get inside soon.
On the parking lot.
Yeah. But you said to me, I think very soon the algorithm will go 100% shares.
Yeah.
What makes you think that?
Well, because I see so 100% shares means that we have low stress and the economy is in a good state, right? The indicator that the economy is in a better state is moving actually quite quickly. And as long as the stress in the market is low, then at one point we'll flip. And we could flip next week or the week after. Or not, right? So if the stress keeps high, then it keeps on 60-40, because then it only goes to 100% equity when the stress is low and the economic outlook looks good. That means that the copper prices increase faster than the gold prices in a big period.
Yeah, right.
And so, yeah, I'm. To be honest, Woody, I mean, when I saw this whole stuff with Evergrande happen, I had a few moments that I thought, this could be a big pop. And it actually ran down with a cis, right? So that's good. But I don't know if you remember 2007. It was not Lehman. It was Lehman that everybody remembers. But before Lehman, Bear Stearns went. Bear Stearns gave basically the signal to everyone who wanted to listen that there was stress in the market we didn't really price in. Now the question is now, and we can never see the future. We always have to look backwards. But the question is now: is Evergrande a blip that shows us something that's going to happen, namely implosion of real estate companies in China, and then probably further on, because the capital exposure in that industry is like massive? Or is this really just like a cis? Like, I don't know, all right? And you don't know. But I think in a few months we can say, oh, it was nothing, or it was the signal.
That's something to come. Yeah. Fascinating. Yeah, I mean, but I won't. I know you're pretty busy, so I won't take up too much of your time. But yeah, we've just recently opened the doors. I think today the doors have opened again for we called it when we first launched your algorithm, and it's kind of a unique offering that we've never really done before. I mean, we've traded share algorithms on to systems to trade shares with, but never in a kind of asset allocation type, using an algorithm to direct the bulk of the capital that you really don't want to put at risk too much.
Yeah.
We called it the golden formula, and we're revisiting that idea. It starts, the sign-up page, I think, was launched today. And yeah, we're basically 11 months on since we actually launched it, and it's doing exactly what we kind of expected, but there are some caveats which we're going to go through next week. So hopefully we'll get some more people to check it out and see what it's all about, because it's a fascinating algorithm, and it really does help you decide where you want to put the bulk of your money as well.
Yeah, and I think what when we launched it first, we launched it as okay, let's try this because it's really different. And what we expected is a lot of people to do exactly, just follow the algorithm exactly. When I speak to subscribers, a lot of them use it to determine the bulk of their asset allocation manually, right? They say, okay, if this algorithm is going to be a little bit aggressive, then I allocate more to shares. And if it's going to be conservative, I allocate more to cash. So there's a different ways that people use the algorithm, which I think is fascinating, right? Because you design a thing such that people would follow it to the letter, and then you see that a lot of people who have good success with it, they actually use it as a general asset allocation method.
And sometimes you don't necessarily have to move on it. I mean, once you get to know what it does, what it indicates, it's more. Sometimes, I mean, I with the capital that I put towards it, I put 10 grand and I to the letter use it. I'm going to start now using, we discussed the other day, that the ETF I use for the bond allocation is TLT, but I'm going to change that to TIPS on the next signal, just because it's inflation protected. But yeah, I've been just so I can see what it goes, and it's working great. Hang on, 30. I think when the markets really did wobble in late August, we were completely in bonds. So that's where the algorithm really.
Yeah, and that's what I always say to people. Like, they say, well, but you don't beat the Nasdaq, for example. Yeah, but if you have the Nasdaq, if you follow the Nasdaq exactly, then you get also all the stress from the Nasdaq. And this is just to lower your stress levels. It's really about lowering the stress levels of your investments, and that's really important.
So I think we'll leave it at there. I think that the sign-up page is up, so you can check it out. But thank you for your time today, Peter.
You're very welcome. And for subscribers and even for non-subscribers, just ask me questions. I mean, I'm pretty open about what the algorithm does. It's a known strategy, but I built some other stuff in it. But I'm happy to answer questions. Hard, not so hard, doesn't matter. I'm on the other side of the line.
No problem. Thanks, Peter. And yeah, I'll see you later for the next gym session.
Yeah.